All right, traders, this is Blake Morrow with Traders Summit, and I'm excited to bring you a brand new contributor to the Traders Summit ecosystem, Eric Basmajian. I hope I got that correct.
Perfect.
All right.
Perfect.
Welcome to Traders Summit, and I'm excited to have you here.
Thank you for bringing me here, and I'm excited to share a little bit about what I do.
You know, I was telling you before that I was really excited to have you on. I've learned a little bit about you over the last several weeks, and listening to your interview that we did with the FACE webinar with the Forex analytics community, you are a perfect fit in with the Traders Summit community because of your macro background and your hedge fund background. So tell us a little bit about yourself and you know what you specialize in.
Sure. So my educational background is in economics. I studied economics at NYU. And right after I graduated, I actually jumped right to the buy side and worked for a couple of years at a quantitative hedge fund that specialized in scanning for mispriced equity derivatives. It was a little bit different than the macro background that I had, but it was a great experience because there was some overlap with mathematics, and I got to improve some of my statistical analysis skills and things like that. But the shop wasn't macro related, which was my core focus. So while I was there, I was continuing my study of economics, most specifically long-term economic trends, debt deflation, demographics, the impact of government size on growth, long-term secular economic trends. But after having experience at a hedge fund, where performance on a shorter term basis was so critical, a long-term thesis is helpful, but it's not actionable for traders.
Yeah.
So I continued my study from a long-term economic analysis, and I incorporated some business cycle research using what we call leading economic indicators. And Jeffrey Moore was the economist who popularized leading indicators. He's called the father of leading indicators, the late Jeffrey Moore. And incorporating the leading indicators is important because what that helps you do is, on a more short-term basis, in the 6 to 18 month window, is forecast the direction of economic growth or the direction of inflation. So on a shorter term basis, it's the direction, or what we call the second derivative, that's the most important. So if economic growth goes from 0% to 3%, that's an increase in economic growth versus it going from 6% to 3%. You're ending up at the same spot, 3%, but those two trends will result in radically different asset performance and sector performance. So we take a long-term view, and then we go shorter term and look at some leading indicators to figure out where the direction of growth will be over the next several months. And when the direction of growth is increasing, as you might expect, stocks perform better than average, industrial commodities perform better than average, and more cyclical equity sectors like financials, industrials, materials perform well. And your defensive sectors like treasury bonds perform poorly. Conversely, when economic growth is declining, it's the flip side. So treasury bonds perform better than stocks on average, and your defensive equity sectors perform better than your cyclical equity sectors. So at any given point, we're looking at the confluence of economic data, and we're making an assessment of what's going to be the trending direction of growth over the next 6 to 18 months. And if that direction is going to be lower, we'll be tilted defensively. If that direction is going to be higher, we'll be tilted more cyclically or offensively. And that's sort of the crux of what I do. 6 to 18 months is the shortest window that I'm playing in. And it's all based on macro. It's no technical analysis.
And, you know, Eric, I'm just going to say, from a trader's point of view, you know, people that love to listen what yourself, the information or the research that yourself gives or other macro people give, you're spot on. It's having a thesis and saying, okay, I understand what the underlying trend is in the markets, but how do I capture that on a short-term basis? And I think what you're saying here is exactly what traders are really looking for. So at EPB Macro Research, who are you finding as your typical clients?
So it's pretty broad. There's high net worth retail clients that manage their own accounts. There's advisors and family offices, down to private equity and hedge funds. It's really diverse, mainly because what we find is this what we call the growth rate cycle is such an important piece of the puzzle in terms of asset allocation and asset performance that it impacts anybody that's involved in capital markets. And just to put a little bit of context behind that, I went back and I looked at all of these growth rate cycles going back to the 1990s, so over 25 years. And these growth rate cycles last on average about 1.5 years. And if you go back over the last 10 years, since 2010, we can see this. So there was obviously a major improvement in growth from 2016 to 2018. Then from 2018 to 2020, even before COVID, growth was coming down. The Fed was cutting interest rates. So you could see that in between an economic expansion, there was no recession, but there were several periods where the growth rate was increasing and the growth rate was decreasing. And those trends, those increases and decreases, last on average about 1.5 years. And if we go back to the mid 90s and look back over 25 years, the average annualized return for the S&P 500 when growth is increasing, when you're in a growth rate cycle upturn, is 20%. And when you're in a growth rate cycle downturn, even if it's not a recession, the average return for the S&P is 4%. So you have 5x the annualized rate of return during an upturn versus a downturn. And then you go beyond that, the volatility is lower, the drawdowns are lower. Basically, what we find is that since 1995, the market was up over 800%. 90% of those gains came during growth rate cycle upturns.
That's amazing.
Less than 10% came during downturns, despite the fact that the downturns took up more time than the upturns. So the upturns occurred less than 50% of the time over the last 25 years, but were responsible for over 90% of the total gains.
Holy
That's
cow.
why the growth rate cycle is so important, and it impacts traders, long-term investors, private equity. It impacts basically every asset class that moves because everything is tied ultimately to the economic cycle.
Well, that's a pretty amazing statistic. And I'm going to tell you on behalf of the Traders Summit community, I'm super excited to be reading your research. And I know everybody here that's listening in is going to be excited to see your posts as they come in. So I want to thank you so much for joining myself today. And I look forward to, like I said, reading your research moving forward and to find out more about yourself. How do we find you? Just finding you.
So you'll be able to see my work on the Traders Summit. I am on EPBmacroresearch.com.
Okay.
Also pretty active on Twitter at EPB Research. And I have some videos on YouTube as well. You could just search EPB Macro Research. And one thing I would encourage, if you're interested in these growth cycles, is on YouTube, I have a video titled The Importance of Growth Cycles. It's only about a 10-minute video. And
Great.
it breaks down everything that I said about the historical performance, the performance during upturns and downturns. So that may be a good place to start if you're looking for more information.
That sounds awesome. And with your permission, we might just grab that and stick that on Traders Summit so
Absolutely.
everybody can find
Perfect.
it. That would be great.
That would be perfect. Yeah.
All right. So again, folks, for you guys to find more about Eric and what he does, make sure you click down below in the description. You'll be able to have links back to where you can find him. Eric, thank you so much for joining me today. And I really look forward to hearing about some actionable ideas and hot, themes that you have moving forward.
Excellent. Looking forward to it.
All right. Have a great one.